Welcome to part 2 of the Quant Crash course, where we take a quick look at value at risk as a concept. The outline for the session at a very high and broad level is basically we start off with an introduction, then jump on to calculation of VAR, then look at VAR methods, three primary methods that are used for estimating value at risk. Um, Tools such as or like value at risk has a number of issues. We look at some qualifications around these issues and also review what Nicholas Nassim Taleb has to say about how these issues and qualifications could possibly be addressed. Now, the easiest way of describing or defining value at risk is to start with a very simple question. And that simple question is, how much can you possibly lose on a bad day? And you can apply this question or you can ask this question with respect to your market portfolio, with respect to your investment and inventory in commodities, um, um, securities, irrespective of whether they are in the fixed income space, in the foreign exchange space, or in the capital market space. How do you answer this question? So if I wanted to know how much can you possibly lose on a bad day on my portfolio, one way of answering this question is by going through value at risk. And you can estimate value at risk at a position, so given security or a given investment, at a script or a ticker, or at a portfolio level. A formal definition of value at risk basically has three elements. So you're talking about a worst case loss, you're talking about a confidence level or an interval, and you're talking about a period of time. So three elements: worst case loss, some element of probability in and around that worst case loss, and a period of time. So, for example, on $100 million portfolio, we stand to lose $2 million over any 5-day trading period at a 95 confidence level. Now, if you were to translate this in English, what you're basically saying is, look, there is only a 5% chance, as per our model, that we would lose an amount higher than $2 million on our $100 million portfolio. So it's one way of answering the how much can I possibly lose on a bad day. In the answer, if I were to look at the statement in front of me, is that okay, on a really, 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 really bad day, I would possibly go out and lose an amount of about $2 million, and this is over a holding period of about 5 days. So starting Monday to Friday, in this 1 week period or in this 5-day trading period, the maximum that I could lose is about $2 million, and there's a 5% chance that this statement would be true. There's a 5% chance that this statement would not be true, that I would actually lose an amount higher than $2 million. So if you take this definition, one of the immediate applications of value at risk, and the reason why this method has gained so much popularity, or at least had gained so much popularity before the financial crisis hit, was its application to estimating capital for market risk, for credit risk, for op risk, and for a number of other areas. And the question that we ask now in front of us, which is how much capital should you put aside for that bad day, is an immediate application of this area. Now, in addition to value at risk, you can also answer this question by calculating and estimating conditional puts by position, ticker, and portfolio. And this is something that we will once again revisit, possibly review in a little bit more detail when we do the part 3 and 4 of this course on capital limit management. The third question that comes up, so the first question was how much money can you lose on a really, really bad day? The second question was how much capital should you put aside to protect yourself against that bad day? The third question that comes up is that how do these two numbers, your worst case loss and the amount of capital that you need to put aside, how would these two numbers change due to the addition of a new position, of a specific position of a given position? And here again, we come back to value at risk, and we call this the incremental value at risk. So on a marginal basis, how much adding a new security or a specific security adds to the overall portfolio VAR. The fourth and final question deals with how does recent risk compare with historical risk and how does that compare with the underlying true distribution? I think if you remember, when we did a review of volatility in part 1, we looked at how vol switched and changed for commodities, for currencies over a period of time. How vol went from under 2% to over 8% in less than a few months, and then was back at under 2% in the same amount of time. And I think this is what this question focuses on, that it assumes, or it's trying to ensure that we understand that vol as a measure or value at risk as a measure is not static. Recent risk may very well differ from historical risk, which may very well differ from the overall underlying true distribution. Now, if I were to take question number 4, and I were to extend this analysis, we've seen this graph before. This is the change, the monthly change in the price of crude oil from one month to the next. And if I were to look at the 3 elements of value at risk, what were the 3 elements? The first element was worst case loss, and if you walk through the graph that you have in front of you, you can see that worst case loss in this case is 27%. If I were to read out this graph, what I'm really saying is that, at the horizontal axis, I'm just tracking the buckets of change in the price of crude oil from one month to the next for a given month. On the left hand side, the vertical axis shows me the number of times a data point has fallen in any given bucket. So example, in the bucket between let's say between 0%, so bucket that starts at about, ends at about -4% and finishes at about +5%, or which has a 0 at the bottom. In that given bucket, I'm saying that there have been about 40 instances in the historical data set that has been used to produce this graph, where price changes fell between -4% to +5%, right? So the first element, the worst case loss, is quite obvious, and that worst case loss is 27%. The second element, over a period of time, the period of time over which these returns or these price changes have been calculated is a month. So I'm saying, the worst case loss over a period of month is negative -27%, right? So the price of oil, the maximum the price of oil has declined in a given month is 27%. The last and final question, though, is what is the probability estimate? Now, we don't have enough information here for us to make that call, but we can, if you really want to do it at a really crude level, forgive the pun, we can do that by just estimating the number of entries that exist in each of the buckets. So if I were to, let's say, look at the 18% bucket, -18% bucket, I'd say I have one entry, another one entry in 13%, then let's say about 5 in 9%, another say 15 in 4%, 40 in 0%, 30 in 5%, another 15 in 10%, and then another 5 in in 14%, and then a 1 in 1%. So if I were to simply add these, 1 plus 5 is 6, 6 plus 15 is 21, 21 plus 30 is 51, 51 plus 40 is 91, 91 plus 15, or possibly 10, or let's say 15, 91 plus 15 is 106, 106 plus 5 is 111, then 12, 13, and 14. So the worst case loss in this sequence is 1 over 114. Of 114 months, there's only one month where the exposure or the change in the price of crude oil was higher than -27%, or was in the bucket that stands from 23%, -23% to upwards of -27%, right? So now we have all 3 elements. We have the worst case loss, which is -27%. We have the time interval, which is a month, and we have a probability estimate, which is 1 out of 114. So there is 1 out of 114% chance that the price of crude will actually exceed a negative shift or a negative change of over 27%. And if you switch on the other side, um, I'd say that you could make the same statement about an increase in change of crude oil. From 1 month to the next, the price of, there's only a 1 out of 114 chance that the price of crude oil would actually increase by a rate, by a number higher than plus 14%. So if I go back to the definition of value at risk that we started off with, worst case loss, confidence level, and a period of time. These are the three primary estimates that are required to answer a question about how much could you possibly lose on a bad day. Now, the questions that we've asked are questions that deal or look at value at risk primarily from a market risk point of view, right? So a shift in market prices for a currency, for a commodity, for an equity market security, or a fixed income bond. VAR as a concept or as a topic has a number of interesting applications that go beyond market risk. And if I were to walk through these applications one by one, for example, one of the questions that I can ask using value at risk as a tool is that what is the probability that margins will decrease in any month over the next quarter, the next half year, or the next full year? Right? So how would you possibly ask this question or even answer this question? You go back to this graph, to the change in crude oil. Let's say you're a refinery, and as a refinery, you import crude oil at a specific price. At any given point in time, you have inventory of crude oil sitting in your storage tanks. You have an inventory of refined products storing in another set of storage tanks, and you actually have a fair bit of oil floating around in the pipeline to and from your refinery, right? So you have three elements. A change in the price of crude oil does not just directly affect your ability to price or sell a product at a certain margin, it also hits you immediately with inventory gain and loss. Right? And if I were to take the same concept about the change in the price of oil, whether it goes up or it comes down, I could basically answer this question that I have in front of me. What is the probability that margins at my refinery will decrease in any month over the next quarter? So the holding period goes from a month to 3 months. For the next half year, the period goes from 1 month to 6 months. Or the next full year, the period goes from 1 month to 12 months. The second question that you can ask is, what is the range of these projected reductions? So, given if that my margins reduced in any month, what is the range of these projected reductions? That's one question. Right? You can also ask, so now the first question focused on probability. What is the probability that margins will reduce? So what is the probability that any number on the margin side, that I'll actually see a number which is less than 0 on the margin side? That was the first question. The second question is, well, if they do reduce, what's the worst case reduction in any month over the next 12 months? And then, in addition to the worst case reduction, what is the most likely reduction in any month over the next 12 months? Right. So now, while the tool is the same, the type of questions that we're asking and answering are now very, very different. We're no longer looking at just market risk or just capital. We're actually trying to see and use VAR or value at risk as a tool for both margin projection as well as margin management. Now, here's a very different, related, and interesting application. You take the same concepts that we worked with so far and turn them into a very different question. What is the probability that gross margins will sink below the minimum profitability threshold? And also, what is the probability that gross margins will actually turn negative? Now, both of these questions are questions that have very important and interesting applications when it comes to tracking, managing, and reducing risk at a senior management level. So you don't have to stop here. Depending on how much data you have, and the level of sophistication of your BI tools, your analytical tools, as well as your senior management board members, you can actually take this a lot more further. In the list of additional questions that allow you to take it further, here's the first one. What's the likely expected gross margin at current price volatility levels? So now what you're doing is you're linking value at risk, margins, and volatility in the same equation. How does this number change if vol moves by a percentage point? And then finally, how much does a dollar change in price change the expected margin numbers? So if I were to take the refinery example that we started off earlier, I would basically need to go back to the crude oil graph that we saw. So this is the data set that's required. The ability to track price changes on a month-by-month basis over the last few years. And as we done the count earlier, I think we're looking at about 114 months, which is just under about 10 years of data on a month-on-month basis, assuming that there are 12 months in a given year. And then take this graph and translate this into something along these lines, where what we're really trying to do is take the price shock. So the highest price shock that we could see in a low volatility environment is about 145. In a high vol environment, it's about 364. So we're saying, prices can go as low as, so in terms of shocks, we're saying prices can move at the most likely level. The most common odds are a price movement of about $2 in a given month, as far as a low vol environment is concerned, and about $4 a month in a high vol environment. And then on the higher side, the worst case movement is about a shock of about 145 and 364. And then you can translate that directly into something along the lines of an inventory loss. So, if prices come down or move up or move down, and depending on which side of the inventory you are on, here's the impact on your inventory, both in a low environment and a high environment. Now you can extend this, and what you've done for inventory could very well be done for margins. And a framework like this, such as the one that you're seeing in front of you, can then very easily be extended to answer the question that we've asked. What's the probability that gross margin will shrink below a minimum level? What's the likely change if vol moves by a percentage point as far as your gross margins are concerned? As well as, how much does a dollar change in price change the expected margin number? So these are all important questions that move significantly beyond the application of value at risk to just market risk. We're now talking about margin management, margin tracking, and profitability projection. So now that we've established that value at risk is an interesting tool that has applications beyond just market risk, and we've also established at least the outline of a framework for tracking how margins move with both price changes as well as price volatility. It is time for us to revisit the initial definition of value at risk. What you're really trying to focus on here is you're saying, look, I need to understand the distribution. And if you've done part one, that's something that you should be very, very comfortable with now. B, I need to have data that allows me to follow the distribution over a period of time. Right? C, I need to establish some level of tolerance that is within my acceptable threshold of pain. And then beyond that, as D, I also need to indicate, the threshold or severity of my losses that is certainly beyond my level of acceptance, right? And I think VAR as a framework does a reasonable job of doing that for you under certain conditions. When we are in the process of wrapping up this course right towards the end, we'll talk about how those conditions work or not work, and what people like Nicholas Nassim Taleb have to say about the same conditions. But for now, let's assume that the framework works, and if the framework works, then what you really want to do is get data, get the analysis, establish some measure of risk tolerance, and also establish your threshold for calculating pain, and then actually go out and put a number against that threshold. So, what's the worst that I can lose? Whether that is 5%, 1%, 2%, 1.5%, half a percent, or 0.1%. That threshold is something that's going to be specific to how you work, measure, and manage risk on your side. But that number needs to be calculated. Second, the framework works for commodities, for currencies, for equities, and for fixed income. Again, there are variations in how certain elements get calculated depending on whether you're working with capital markets or commodities or foreign currency or fixed income. But those adjustments are minor. As long as you're comfortable with the framework, as long as your board and your management team is comfortable with analyzing the results, translating those results, and answering or rather transforming those questions from pure market risk to actual margin analysis, I think you'll do fine. Okay. So now it's time for us to take a slightly deeper look at value at risk as a concept. Um, by now, I think you should be fairly comfortable with histograms, and I think that's there is a reason behind this madness. You'll see that I am actually fairly biased as we move forward in our course towards historical simulation as a tool. I've used Monte Carlo simulation, I've used historical simulation, and I've used the variance covariance method. All three methods are methods that we discuss later. But in terms of preferences, as I'll state later and very clearly indicate also, the tool that I'm most comfortable with in terms of its efficacy, its results, and its ability to work with the true distribution is historical simulation. So now, what you see in front of you is an extract from the annual report of Chase Manhattan Bank, and what you see here is a distribution of daily market risk related revenues for 1998 and 1997. And you can see that there have been a fair number of instances where the banks made money above and beyond $30 million, and there have been instances when the bank has actually gone out and lost money beyond $30 million. Luckily for the bank and for the team that works at the bank, the number of instances where they made money beyond $30 million is far, far, far greater than the number of instances where they actually lost money beyond $30 million. So that part is here. The two twos that you see right towards the end, again $30 million, then a 3 and a 2 for 25, a 1 for 20, 3 and a 1 for 15, a 4 and a 5 for 10, 9 and a 7, and then a 0. Right? And then on this side you see 5, 10, 15, 20, 25, and 30. Right? So this is one way or one mechanism of showing value at risk. The method used here, again, if you go back to the checklist says worst case loss $30 million. Period of time in this case is daily market risk, so daily numbers. Confidence level, just take the two tools that you see on that side, and I'm assuming that since this is market risk related, trade related, you're most likely looking at about 250 days. So 2 days out of 250 if you want to use 1 year, 4 days out of 500 if you want to use 2 years. That's your confidence level, that's the probability estimate, that's the threshold. You're saying there's only an X% chance that you'll actually see a loss exceeding $30 million on this side. And on this side, you're saying there's only a X% chance that you'll see a gain greater than $30 million on a given day. Now, in essence, if I were to take everything that we covered so far and translate that into a diagram, you'll come up with something along these lines. So you're starting at point 0, and you're saying at point 0, I have a current value or a spot price for the security or the portfolio. There are multiple possibilities. I'm interested in two: what's the best case and the worst case. And the best case and the worst case both come from a distribution of underlying returns, which we have to estimate or assume. And then with respect to the worst case, I basically want to translate that worst case into, again, expected loss over a period of time, which in this case is 10 days, and at some confidence level, which could be 1% or 99%, depending on how you slice and dice the distribution. So the process for calculating value at risk starts with your estimate for variance or standard deviation, an indication for the time period in question over which this estimate would be made, a level of confidence at which this estimate would be calculated, an assumption that normality of returns is fine as far as your portfolio and your work and your analysis is concerned. Um, then now, depending on what you're doing, which market you're working with, you may or may not calculate interval mean. In most cases, you will actually skip this step. Then calculate interval sigma. So when I say interval sigma, if I'm looking at 5-day wall or month-long wall or year-long wall, whatever interval has been specified, I need to estimate that number. And that number can be calculated by two ways. One is that I start with my estimate for volatility at a daily level or VAR at a daily level, and I scale it to the period in question. Second is depending on the availability of data and the tools. If I want to calculate returns on daily, weekly, monthly, yearly basis, I can do that and then use that as a basis for estimating sigma or standard deviation. Then once you've done these 6 steps, the last 2 steps is calculate the inverse of standard normal distribution and then calculate value at risk. So what we'll do is we'll run a very simple calculation to walk through this process to ensure that we're all comfortable and we understand how does the process for calculating value at risk actually works. Right. Now, the slide that you see in front of you basically has market data. So I have 2 securities. I actually have 3 securities, but I'm showing you returns for 2 of them. So security 1 on 1st of Jan 2004 starts at the price of 38.5 and finishes at the price of 38.85. Security number 2 starts at the price of 36.6 and goes all the way down to 37.6. Security number 3 goes from a price of 287 all the way down to 279 and then closes at 281, right? Immediately after the closing price, you actually have what we call an estimate for daily return, which is simply the daily price change between 2nd of Jan 2004 and 1st of Jan, and then 5th of Jan and 2nd of Jan because 3rd, 4th for the weekend. Then 6th and 5th, then 7th and 6th, then 8th and 7th, then 9th and 8th, and so on and so forth, right? So this is the starting point. This is the data set. The data set has closing prices and closing rates. Using those closing prices and closing rates, we go out and estimate the daily percentage change as far as a given security is concerned. Now, where does this daily percentage change comes from? If you're working with Excel, within the field of risk management, our preferred mechanism for estimating daily returns is to take the natural log. So you take P1 over P0 or P2 over P1 or P3 over P2 and so on and so forth, and you take the natural log of that calculation. So the 0.0026 that you see is actually natural log of 38.4 divided by 38.5. Similarly, the 0.0155 that you see here is basically the natural log of 38.9 divided by 38.3. So far so good. So what we basically done is take closing prices, with the closing prices calculate daily returns, using natural logs, and then once you've done this, you actually have a full series, right? So you have a series of daily returns that you've estimated using this approach. All you now have to do is take the standard deviation of the series and you have your volatility or your estimate for vol for this given specific security. So if I go back to the series of steps, after I'd done my data, after I collated my information, one of the things that I had to do was calculate volatility. I've done that. The next thing I had to do was calculate the standard normal, the inverse of the standard normal distribution, so that I can pick a number or a factor that I can use for multiplying this vol estimate. So now the question is, at what level do you want to calculate this vol estimate? Do you want to calculate at 5% interval? Which would basically mean that you're saying there's only a 5% chance that you'll see a higher loss over the holding period. Do you want to use 97%, where you're saying there's only a 3% chance that you'll see a loss higher than this number? Or you want to use 1%, where you're saying there's only a 1% chance that you'll see a loss higher than this number. So let's say we pick 99% or 1%, And we're saying the factor that corresponds to this as far as the normal inverse distribution is concerned is 2.326. So from a calculation point of view, we are assuming that we have a trading book of 100 million. We are assuming normality of returns. We're saying liquidation period is not a problem, it can be in hours. We're looking at a 1 in 100 day loss or 99%, and we're looking at, let's say, a yearly variance of 25%. So now that we have this data, remember, data, daily returns, standard deviation, which is your wall estimate, then picking up the confidence level or a factor that you want to work with. When we picked ours, and that's 2.32. Then taking a look at the trading book and the overall yearly variance. Now, if we take all of this, if we take all of this together and use that as an estimate or use that as an input to our process for calculating value at risk, the next series of steps are here. So the daily standard deviation, the yearly standard deviation is 25%. With 252 trading days, we have to multiply 0.25 by the square root of 1 over 252. And the reason why we do this is what we're really trying to do is you're trying to say, take the yearly standard deviation and translate that into a daily standard deviation. So the 25% annual number converts to 1.57% on a daily basis. The 1 percentile value for standard normal distribution is 2.33. So that becomes a multiplication factor. Multiply 2.33 by the daily standard deviation is 1.57 to estimate value at risk at 3.65% at a percent level. And then a 100 million portfolio with a 1 day VAR of 3.65 million. So that in essence is the process. Now this process is what you call the variance covariance approach, because what you've really done is that you've estimated value at risk at a portfolio level or at a security level, and then you've taken that value at risk and you've assumed normality of return, which is where the inverse standard normal factor, the 2.33, comes into play, right? This step where you say look up 1 percentile value for standard normal, you've just switched to the VCV approach or the variance covariance approach, and then you've taken that number, extended that by the factor that you've estimated, which is 2.33, to get an estimate of 3.65%, which then gets applied to the 100 million portfolio with a 1 day dollar VAR estimate of 3.65 million. Right, now if you're working for bonds, so our assumption when we did the first calculation was that we were working with a portfolio where everything was either in commodities or in currencies or in capital market securities. However, when you work with bonds, there is an interesting issue, and that interesting issue is that, so what you see in front of you is the return series, the rate series for 6 months, for 1 year, for 3 year, for 5 year and 10 year rates. So we're saying, rates go from 1.87 to 1.98, for 6 months go from 2% to 2.25, for 1 year go from 3.7 to 3.86, for 3 years from 4.8 to 4.9, for 5 years from 6.45 to 6.83, for 10 years as far as this period is concerned. And then we go ahead and calculate our daily returns, again using the approach that we've discussed earlier for this entire series. Now the only problem here is this question, and that question is, I have, let's say, a 6-month treasury bill or a treasury bond, and that 6-month treasury bill and treasury bond has, let's say, 10 days to go. So I apply the fortnight, I look at the rate, the series of interest rates on a fortnightly basis over, let's say, the last 2 years. I calculate or estimate volatility for that series, and then I calculate, apply that simply to my portfolio. So I have a 6-month treasury bill that has 10 days to go, and let's say this treasury bill has a volatility of 15%. If I were to use this approach, then what I'm really saying is that the price change as far as the treasury bill is concerned is about 15 days, which you will find is going to be a fairly mistaken assumption. A treasury bill that's about to mature in about 10 days time, while rates may vary fairly significantly in that time frame, as far as the price of the underlying instrument is concerned, that price is fairly stable. So this method will most likely not hold for 6 months or 1 year rates. Even for 3 year, 5 year and 10 year rates, I think you'll have a problem. So one of the questions that comes up is that when you calculate value at risk for bonds, Are you calculating value at risk for bonds using rate volatility or price volatility? And you find that the choice of these method has or makes a world of difference in the VAR level that get estimated, as well as the acceptance of those VAR levels as far as your treasury and senior management teams are concerned. So here's a plot that actually shows you how rate and price fall changes, and at the bottom of the graph you'll see that we have an estimate for modified duration, a concept that we covered earlier on in part 1. And on the left hand side, on the vertical axis, you have a list or a range of rates going from 0% to about 20%. And the question that I'd like to ask is that if you look at rate volatility, so sorry, the vertical axis is rate volatility, which goes from 0% to 20%, and the horizontal axis is modified duration in years. So 0 year, 3 years, 6 years, 9 months. Oh, sorry. So it's yeah, it is